Fresh data says the Chinese economy is slowing fast, with misses dragging consumer prices to flat on the year, while producer prices, what factories get at the gate, are down 5.4%, which is the biggest drop since 2015. That would make close to 15 years now that the Chinese stock market has actually been flat. What's happening here is Chinese consumers aren't buying, while worldwide recession is hitting both commodity prices and exports. So Americans and European buyers are not picking up the slack, leaving unsold goods in China. The larger background is that China's COVID shutdowns were savage. You'll remember the videos of people welded into their houses or shipped off to city-sized isolation camps. This meant that when the Chinese economy finally reopened, hundreds of thousands of small businesses were gone, shifting the Chinese economy towards bigger businesses that were able to weather the lockdowns. So basically an intensified version of what we have in the US, where mom and pops were forced to shut down while Walmart could keep running. The even wider backdrop is that President Xi has been terrible for the Chinese economy, and those chickens are coming home to roost. The three previous presidents managed average GDP growth in China of 8.6%, 9.8%, and 10.4%. That was over decades. That was the Chinese miracle. In 10 years, Xi has managed just over 5%, which is pretty standard for a poor country, and that's about half his predecessors. And even that was largely driven by debt. This is because Xi's priority has been control rather than growth. He launched regulatory crackdowns on industry after industry to cut down to size entrepreneurs and take out any potential rivals. One prominent victim was Jack Ma, the founder of Alibaba, and roughly the Chinese equivalent of Steve Jobs in terms of inspiring young Chinese entrepreneurs. So what is next? Normally, governments use deflation as an excuse to pump out yet more trillions in stimulus. In China's case, though, they are already swimming in debt. The Wall Street Journal estimates about $50 trillion of non-financial debt, which has tripled in the past 10 years. And most of that is in heavily leveraged companies. In fact, total debt in China, that's government, business, and household, is now at 295% of GDP, which is even higher than the US at 258%. Chinese have already shifted to deleveraging, paying off debt instead of spending. Households are prepaying their mortgages and paying off their credit cards, while companies are taking money that they might have invested in new capacity and instead paying down debt. The upshot is that manufacturing has actually declined in China for 5 months now, and private business investment is almost flat on the year. Even the famously freewheeling local governments are now cutting spending and laying off workers. The fear in China is that they go down the path of Japan, with a slow motion deleveraging sucking the energy out of the economy, in Japan's case, for decades. A downshift in China to 2 or 4% growth will not play well with a Chinese public who has gotten used to fast growth. They take it for granted at this point. And slow growth paired with already historic highs in youth unemployment could lead to political threats or even social unrest. In the 2008 financial crisis, China was talked up as the cavalry that would come in and save the global economy. This time around, China may actually be in worse shape than the rest of us. Okay, we'll be watching. See you next time.